The stock market is either the greatest wealth-building machine in human history or the fastest way to watch your coffee money disappear into a digital void. And right now, in 2026, figuring out which one you're dealing with might actually matter more than ever. Volatility is back, headlines are screaming, and somehow everyone you know has a hot take, but nobody has a plan. Here's what's actually happening underneath all the noise. Interest rates have been doing their slow, grinding dance for 2 years now, and the market has been reacting like a teenager, grounded for the weekend, erratic, emotional, and convinced everything is the end of the world. When the cost of borrowing goes up, the math behind stock valuations quietly shifts, and suddenly, that high-flying growth stock you loved looks a lot less sexy on a spreadsheet. We were riding some serious optimism not long ago. Remember when everyone was calling for a soft landing and champagne toast on Wall Street? Now the same analysts who are pounding the table bullish are hedging their language faster than a politician before an election. The mood has shifted from buy everything to, well, it depends, which is honestly the most honest thing Wall Street has said in years. And look, the psychological toll of that whiplash is real. Watching your portfolio bounce like a pinball machine messes with your head in ways that pure logic can't always override. Nobel Prize-winning economist Daniel Kahneman spent his career proving that we feel losses roughly twice as intensely as equivalent gains, which means the market doesn't just hurt your wallet, it genuinely warps your judgment. But here's the thing, markets have always cycled through fear and greed like seasons, and the investors who built generational wealth weren't the ones who timed it perfectly, they were the ones who stayed boring on purpose. The S&P 500, going back to 1926, has delivered an average annual return of roughly 10% through wars, recessions, pandemics, and whatever you call the last few years. The lowest risk entry point into that long-term machine right now isn't some secret hedge fund strategy, it's index funds, specifically broad market ETFs that track the total market or the S&P 500, and yes, we're talking about the same boring advice your financially responsible uncle has been giving you since 2008. The irony is that the simplest tool is almost always the most powerful one, and most people ignore it because it doesn't feel exciting enough to brag about at dinner. A common misconception is that low risk means low return, but that's not really what the data says. It means you're reducing the risk of catastrophic loss, not capping your upside over a long enough time horizon. Dollar cost averaging, which just means investing a fixed amount consistently regardless of whether the market is up or down, removes the single most dangerous variable in investing, you and your emotions. History keeps handing us the same lesson in different packaging. The people who panicked and sold during the 2008 crash, the 2020 crash, every crash locked in their losses while patient, systematic investors eventually recovered and then some. You don't have to be smart, you just have to be consistent, which is somehow the hardest thing in the world for human beings to actually do. If you're newer to this, think of your position size like a volume knob. You don't blast music at full volume in a library, and you don't put your entire net worth into equities the week before a Fed announcement. Start with an amount that, if it dropped 30% tomorrow, wouldn't change your sleep or your lifestyle, because at some point, it might. Diversification across sectors through something like a total market index fund is essentially the market saying, we don't know which horse will win, so we own the whole race. That's not pessimism, that's just rational humility dressed up in financial language. And right now, humility is actually the highest performing asset class. We should also talk about tax advantage accounts for a second, because putting your index fund exposure inside a Roth IRA or a 401k is like getting a cheat code that most people are just leaving on the table. The government is literally offering you free optimization, and the majority of people either don't know or don't bother, which is both infuriating and kind of an opportunity if you're paying attention. The real flex in 2026 isn't picking the right stock. It's having a written plan, a defined risk tolerance, and the discipline to not look at your portfolio every 12 minutes like it's a social media feed. Process beats prediction every single time. And the investors who understand that are playing a completely different game than everyone panic refreshing their brokerage app. Here's the philosophical truth underneath all of this. Wealth isn't built in moments of brilliance. It's built in years of boring, repeated, disciplined action. And the market will reward that patience, whether you believe in it or not, because belief is irrelevant. Behavior is everything. Size your positions wisely, diversify broadly, invest consistently, and let time do the heavy lifting that your anxiety keeps trying to steal from you. And if the market drops tomorrow, good, you're buying more units at a discount. And future you is quietly grateful while present you is stress-eating snacks and reading Reddit threads. Prepare rationally, act systematically, and let the noise be someone else's problem. If any of this got you thinking about building real wealth across multiple asset classes, whether that's the stock market, real estate investing, home contracting projects, or finding the right lenders to make it happen, check out the links in the description below and let's figure out your next move together.